Hello everyone, what is up? My name is Reese and today I'm back at it again with another video, and today I will be talking a little bit about a topic that I personally find really interesting, and it can really lead you down a rabbit hole as you get into it. And what I'm going to be talking about today is dividend investing and what the difference between high dividend yield and high dividend growth is. Now, these are both strategies that utilize dividends to help suit your investment goals. However, they do that with two very different goals in mind, or two different investment approaches in mind. And so the three funds that I will specifically be talking about is the Vanguard High Dividend Yield ETF, which is VYM, Vanguard Dividend Appreciation Fund, VIG, and then the Schwab US Dividend Equity Stock, which is ticker SCHD. Now, after doing hours upon hours of research, these are the three funds that I really believe kind of stand out to me, and I'll talk about why shortly. And obviously, these are not the only dividend ETFs out there. There's dividends that ETFs that have higher yields or potentially higher growth rates. However, these top three are what I personally believe are the best at what they do, and I'll get into that shortly. So getting into this brief overview of all three of these ETFs, they are all dividend paying funds, but the difference between them is that Vanguard High Dividend Yield is focused on on selecting companies that have higher dividend yields than the overall market, indicated by 3.21% yield. As of right now, the S&P 500 is paying about a 1.7% yield, so it is, a little bit almost double the overall market. And Vanguard Dividend Appreciation is a growth fund that is targeted towards companies with growing dividends. And then the Schwab US Dividend Equity has a few different filters that it uses to select their stocks, which I'll get into it shortly. And as of right now, SCHD does have the highest dividend yield at 4.39%. But I will be getting into why dividend yields alone are not equal. So start this off. Basically, the idea between investing in a company with growing dividends and high yield comes down to this. A company that's paying high dividend yields is basically what you are trading off is potentially getting a lesser amount of return when it comes to your overall principal balance. Instead, you're getting that return through dividends. And then a dividend appreciation funds are typically companies that are focusing on growing their company rather than paying out a higher dividend yield. And they are basically working on expanding their company and rewarding the investors that join them throughout the way. So getting into this a little bit more, here is an example of what I mean by dividend growth funds versus a high dividend yield. So VYM is indicated in orange, and the blue line is VIG, which is the Vanguard Dividend Appreciation Fund. So as I mentioned before, the Vanguard High Dividend Yield is how it selects stocks. Is essentially, it is defined as being a more conservative approach to high dividend yields, meaning it's selecting companies that are ranked by their forward dividend yields for the next 12 months. And it's basically selecting companies with above average dividend yields. And it's not really getting into as much, quality and strong financials. It's simply trying to find these companies that are paying above average dividend yields. Moving on to VIG, Vanguard Dividend Appreciation. This fund specifically selects stocks and selects companies that have been paying dividends for at least 10 years. And as part of their screening process, they exclude the top 25% of dividend yielding companies. What that means is historically, companies that pay a really high dividend yield often can be viewed as unsustainable. If you see a company with a 10, 20, 15% dividend yield, this can be really out of nowhere. You might think that, wow, that's an amazing dividend yield, I'm going to buy it. And it's kind of a dividend trap, because you could be potentially investing in a company that's paying off an unsustainable dividend yield, and they might be cutting their dividend yield in the future in order to maintain, strong financials, if they even have strong financials to begin with. So companies that are paying high dividend yields, it's always good to really get into it to understand, truly how that company is doing, because overall, typically, companies with really high dividend yields in the long run are not performing as well as a company with strong financials but maybe a lower dividend yield. So what I mean by that is essentially VIG is getting rid of the highest paying dividend yields and truly focusing on companies that have been paying us dividends for at least 10 years and are focused on growing their dividend yields annually. So basically this index fund is going to have yields that are only a little bit higher than the overall market. However, it's really focused on companies with a strong dividend history and a history of growing those dividends. And SCHD is a little bit more complicated when it comes to their screening, but it's really something that I really believe is a pretty amazing fund. So what it does is it basically takes every single stock available in the US market and it narrows it down using a few different filters. So first off, it must have a company to be included in this fund must have paid a dividend for at least 10 years, similar to VIG. And after they get that filters out a ton of companies just with that filter alone. After they use that filter, they take into account fundamentals to analyze the financial strength of the companies that are included in this. This is something that VYM does not do when they're searching for high yield companies. So SCHD is looking for companies with dividend growth, strong cash flow to debt ratios, return on equities, and higher dividend yields. So it's looking for companies that are not only paying out dividends, but they're paying out quality dividends, sustainable dividends with strong financial track records. And so SCHD is kind of a blend of both VYM and VIG in the regard that it's paying off above average dividend yields while also focusing on dividend growth. So SCHD is on its own. I personally wouldn't put it into either a high dividend yield or a high dividend growth rate. It's simply kind of a blend of both worlds, and that is why I've included it in this comparison video. So now that I've talked a little bit about what these indexes are, I'm going to talk a little bit about essentially what that looks like in terms of portfolio performance. So when you're investing in a company or a fund that's paying off higher dividend yields than average, you're typically paying for that in terms of portfolio growth in the long run. So seen here is VIG on the top, dividend appreciation, and then the second bottom graph is VYM, and this is a percentage graph, so that means that it's purely just percentage changes over time. And as we can see, the companies that are focusing on growing their dividend over time and reinvesting that to grow their company are typically growing at a faster rate, and that is rewarding shareholders with increased portfolio returns compared to companies who are investing in higher dividend yields. So these higher dividend yield companies, they have been growing in this fund, but maybe not so much as the high dividend yield. And pulling up TD Ameritrade, one thing I really like about TD Ameritrade is that you can really pull up everything side by side to basically see how these funds would perform over time. And one thing to know about these dividend funds is they can really shine in downturns, meaning because these dividend paying companies are typically more value oriented with stronger financials, they might be less risky than the overall market. So for example, the total market VTI, which is my personal favorite total stock market index fund, has returned minus 18% in the past year. VIG dividend appreciation has lost 10%. VYM, which is a high dividend yield, minus 5.4%, and SCHD, which is kind of a blended fund, minus 7.5%. So overall, these funds are holding up when it comes to these downturns because their stronger financials are going to be what carry these companies through a potential recession or a downturn. And what's really nice about dividend funds is they're going to keep paying hopefully will keep paying their dividends no matter what, especially when you're in these diversified index funds. You're very less likely to have your dividend cut completely. Whereas if you invest in an individual stock, they could potentially completely cut their dividend because they need to tighten up cash flow. So going into the performance, long term, since in the past 10 years, SCHD has returned to value, rewarded investors with a 12% return on average, VYM 9.9%, VIG 10.7%, and the total market 11.34%. Keep in mind that this is including reinvested dividends. So as we can see here, total return-wise, VYM is kind of trailing behind, whereas SCHD, VIG, and the total market are kind of just all grouped together. And moving into portfolios, you're going to see that these companies are, what I really like about SCHD is that it contains companies that you're typically not seeing in the top 10 stocks otherwise in most ETFs. So in the total market, usually we have Apple, Microsoft, Amazon, Tesla, Google, these big companies that are just kind of in every single index fund out there. VIG, which is focusing on companies paying out a history of dividend growth, is going to be kind of similar in the sense that it's going to provide exposure to companies like Microsoft, Johnson & Johnson, United Health Group, JP Morgan. These are companies that have been in Home Depot. Home Depot is a pretty solid company as well. It has to have a good history of dividends. So dividend appreciation is focusing still on these companies that are growing and raising their dividends. And so a lot of this might overlap, such as Microsoft and United Health Group. Moving into VYM, it is going to have more energy exposure than the total market or VIG. But so, for example, we have ExxonMobil and Chevron in the top 5 holdings. So these are companies that are paying out high dividend yields, maybe not growing as much in the long term when it comes to stock market cap, but they are paying out strong dividends. And then SCHD, we have quite a few companies that, might be spread out through the list, but, we have Cisco Systems, Coca-Cola, Amgen, Verizon, Home Depot, IBM, Texas Instruments, which is when I first saw this, I was like, wow, I am very familiar with Texas Instruments and their calculators and things like that. So seeing that as the top 4 holding was really interesting to see that in SCHD, because SCHD will rebalance every year to kind of, if a company cuts their dividend, typically it will get cut out of SCHD. And then, so it's always rotating companies, and SCHD does not let a singular stock hold more than 4% of the portfolio once it gets rebalanced. So it rebalances, I don't remember the exact amount of times it rebalances throughout the year, but it does rebalance to keep any individual stocks from taking over the index fund. And so it's pretty interesting seeing this, how the breakdown is. So you have less technology in these high dividend funds on average compared to growth and the total market. So it's just kind of cool things to look into and see on your own about as you do your research, kind of really seeing what's in them. And then going back to the capital appreciation. So as we can see, when you're investing these higher yields, you're getting less returns over time compared to dividend appreciation funds that are companies focused on growing their dividends. Now here is where things get really interesting. When we adjust to account for dividends, suddenly this changes. So if we start this in 2008, right before the housing market crash, and we invested in both VYM and VIG, it kind of goes back and forth over time, but they don't really perform a whole lot differently. Granted, it depends on if you invested before the Great Recession, during it, or after it, but here's a great example right here. If we invest in 2011, there's periods where high yield was actually growing more, and then now alternated to the high dividend appreciation, and then now it's kind of tied. Within a 1% margin if you had invested 11 years ago. So what does that mean? What that means is, in theory, these two funds are essentially returning the same kind of returns yield-wise in the long run. However, VIG is achieving that through capital appreciation in the share price, and VYM is more so accounting for that growth through dividend payouts. So if you are reinvesting your dividends with VYM, you should or see a very similar return as VIG. And remember, that is with reinvesting dividends. So what that means for the average person is that if you are someone who is trying to rely on dividends to supplement income, investing solely in dividend appreciation may not be the best route, because dividend appreciation is going to have a lower dividend yield than a high dividend fund like VYM. And so that trade-off is, if you want higher capital appreciation, usually you're going to get less dividend growth, or less dividend amounts yield-wise. So that's the trade-off. You want higher capital appreciation, or you want higher dividend payments. And reinvesting them, the higher dividend payments, it kind of equals out. Now we're going to throw SCHD in the mix. And adjusting for dividend yields, it's kind of in the middle of the pack for the most part, and it's been really shining since December 20th of a couple years ago. That's when it really kind of just took off, and it's been kind of holding the crown as the best performing dividend yield ETF as of right now, which also, with it having such a high dividend yield of 4.4% as of current market prices, with the share price hovering around 69% or $69. Nice, I know. But that is a pretty good price point for this dividend fund. And if we see another 10% dip or so, this could be a really strong buying opportunity for any dividend paying funds. And then now, if we take off the accounting for reinvesting dividends, you will see that now SCHD, once again, it's basically lining up with the performance of VIG. Now, it was beating VIG for a bit, and it kind of depends on, when you zoom in. So if we zoom in to post-COVID, or the post-COVID sell-off, SCHD has been performing pretty well. So what am I getting at is, with dividends, incorporated into the total returns, higher dividend yielding funds can hold their ground depending on the ETF. A big example is HDV. HDV is an iShares Core High Dividend ETF, and even with reinvesting your dividends, it's still lagging, and that's why I've really narrowed it down to VYM, VIG, and SCHD. All right, so now that I've said all that things, and what are your takeaways from that? Well, here's what I have to say after basically all that data dump. If you're someone who is focused on a more of a long-term time horizon, where you're not trying to essentially live off your dividends, investing more in stocks that are paying a dividend growth, or dividend growth in mind, versus a high dividend yield, in the long run, that can help you build higher capital. Now, if you are focused on short-term returns, in the sense that you want to start seeing your passive investments or passive income start coming in now, rather than waiting 10 or 20 years, for example, higher dividend yield may be your best route, because you're trying to see that money and capitalize on it now, rather than reinvest it into the stock as the dividends come out. So that is why there is no right or wrong answer to how you want to go about it. It simply comes down to what your purposes and goals are with that income. And personally, what I believe in is, why not both? Why not take advantage of the capital appreciation of a fund like VIG, while also taking advantage of the dividend yield of a stock like VYM? And the reason why I think that using both strategies in tandem with each other is because you're taking advantage of basically the best of both worlds. You're not putting all your eggs in one category. You are diversifying between dividend growth and high dividend yield, so that you can, realize those gains and kind of supplement your income as you need, or keep holding and reinvest those dividends. And no matter what, I think you have a good You're going to be in a good situation in the long run if you invested in any of these three funds. So personally, what I recommend based on these findings is I think SCHD is the clear winner because it has high dividend growth, but also high dividend yield. Right below that, I'd say it's kind of a tie. And I know that may not be the answer you want, but VIG and VYM, I believe that they are both excellent investments, but different goals in mind. VYM, if you want higher dividend yields to supplement your income now and start retiring on it, or just, to use that income to start paying off bills. VIG is going to have lower dividend payouts, but you are getting an excellent capital appreciation in the long run. You're investing in strong financial companies, and these companies are growing with a strong financial history to support that growth. So using both in tandem, or using all three funds really can really, like, for example, you could do 40% SCHD, 30% VYM, and 30% VIG in your dividend fund, for example. Or just, obviously you don't need to make that allocation your total, only invest in these funds and nothing else, but focusing purely on dividends, I think these are going to be your three best bets when it comes to dividend ETFs. And that is essentially, I will be providing the links for all the references below in the description. And finishing this off, I'm going to go into some fund overlap. So when we compare VYM to VIG, there's a surprisingly a pretty big overlap. 49% of VIG is also in VYM. So whether you're investing in the dividend appreciation or dividend yield, you're kind of getting an overlap between the two. And so that's why I don't really think that, even more so, that there's no right or wrong answer for one or the other, because they're both dividend funds, and they are going to share some companies, especially with, this kind of sector. Now we look into that overlap with SCHD. You'll see that some of VIG is in SCHD. Some of VYM is in SCHD. So SCHD is composed of a 45% combined total, basically, of VYM and VIG. What does that mean? It means that a lot of these dividend funds are going to be overlapping each other, because at the end of the day, dividend companies, when you're filtering out stocks based on dividend yields and dividend growth and payouts, there's only so many companies that really fall into that those filters. So seeing some overlap, isn't really going to be avoidable unless you were only investing in one of these ETFs or the other. So I know there's a lot of data, a lot of numbers, and I can do future videos focusing on short videos solely looking into individual funds, such as a video, like a 5 to 10 minute video dedicated to SCHD or VYM or VIG. This is kind of meant to be a general overview of how higher yield versus dividend growth works, and things to think about as when it comes into what you need those funds to do, and how it fits into your investment goals. So thanks for watching, guys. I hope you guys enjoyed this. Starting off, as I mentioned, a lot of my videos are going to be more big picture, diving into a bunch of different options and things to look at, investment options to kind of help you meet your goals. And as I get more content out, I hope to start shortening these videos to help, get specific on basically individual stocks, funds, or categories. So I hope you guys are finding this informational. I really enjoy doing this research and kind of just learning about different investment options and what these funds are composed of, how it works, and how you can incorporate these to best fit your strategies. So thank you for watching, guys. If you have any feedback or content suggestions, comment below. I'd be more than happy to take a look and see what I can do if it's something that looks like I can talk about. And that pretty much sums up this video. Hope you guys enjoyed. Hope you guys have a great day. Thank you for watching. Please subscribe if you want to see more content like this. Help support the channel. Good night.